All right, welcome everybody. Thank you so much for joining us today. This is Buying Rental Properties the Right Way. My name is Sean McKay with American IRA, and today I'm very happy to have with us Mitchell Puckett. He is the Director of Investment for Jameson Property Investment. Mitchell, thank you so much for joining us, buddy.
Oh, my pleasure, Sean. I really appreciate you having me on today to talk real estate.
Absolutely. So for anyone who's ever listened to our guest webinar presentations, we're kind of sticking with our typical theme. Really what I like to do is I like to bring on smart people, people that I like personally, people that I've known for a number of years and who have added a lot of value to my knowledge, my kind of investment career, and they've been phenomenal resources for our clients. So we're certainly never in the business of promoting services, products, what have you. But if they're on our air, essentially it's because we like them and we think they do good business. So that's definitely the case with Mitchell. Again, I've known him for a couple of years and incredibly sharp investor, entrepreneur. He's been in the game, everything from land development deals to corporate leasing. He's an experienced landlord investor himself. So I think he's going to be kind of the perfect guy to guide us today in this discussion about rental properties. So appreciate everyone joining us. Now, if you're listening to this live, we do have a questions box, so please feel free to type any questions in. And at the end of the presentation, we'll just dig right into that and we'll kind of open it up for that Q&A section. And certainly I appreciate that most of these questions will probably be for our rock star today, Mitchell, who's going to add a lot of value to the content. So from a structure standpoint, the way that this typically flows is I will do about the first 10, hopefully no more than about 15 minutes. We have a lot of non-clients on the webinar today. So we'll just kind of introduce the topic of self-directed IRAs and 401ks. And then I'll turn it over to the main event and Mitchell can talk to us about the real estate market. He'll talk to us about rental properties and kind of how to think about these and analyze rentals, because certainly we see a lot of investors that are getting into the real estate investment game. So we want to make sure we're doing this the right way. So Mitchell's going to help us out with that. So again, I really appreciate everyone taking time out of their busy schedules to spend a little bit of time with us. And hopefully there'll be some value in there for you today. So at American IRA, we're very unique in the self-directed arena in that we're one of the very few fully integrated self-directed providers. And what that means is that we have the same ownership group for American IRA, which is our administration company, as we do for New Vision Trust Company, which is the parent custodian. And really the reason why that's important to you as a client is it means that you get consistency in the processing and the compliance for your retirement account. Unfortunately, in the self-directed arena, most of the time what you see is that the administration company is kind of forced to find a new home, a new custodian, every couple of years, just based on the preferences of the types of businesses that the custodian wants to be involved in on an annual basis. So that can make it really kind of a precarious and frustrating business model, not only for the administrator, but for the clients that have to deal with new policies and regulations for these new custodians. So again, as I said, we're one of the very few fully integrated providers. So you do get consistency from year to year. Really the only time where the policies are going to change and the paperwork changes is when we get that sort of information from the banking commission saying that, just based upon regulatory issues and elements that have come about, all financial services companies must adhere to policy X, for example. So it just allows for a very smooth experience for the American IRA client base. Now we have offices, our headquarters is in Asheville, North Carolina. And we also have an office in Charlotte, North Carolina as well. So even though we're located in North Carolina, we do have clients nationwide that also invest nationwide. So we are a full service nationwide self-directed provider. So I'm a very simple guy. Anyone that's listened to our content knows that I keep it very straightforward, very simple. That's really the only way I can think, quite frankly. So when I think about what differentiates us from other self-directed providers, for me, it really boils down to two things. The first is fees. Fees are obviously very critical when we think about financial services. Certainly the vanguards of the world have done a tremendous job of growing because they are a low-cost provider for their service. We're really following the same model at American IRA. What you find typically in the self-directed arena is that the annual fee is charged either based on the account value or the number of assets. So with account value, you're going to be charged more money each year as your account balance grows. Our philosophy is that that's not fair because essentially you as the client are self-directing your retirement account. You're growing this account based on your knowledge and your expertise. So for us to get to make more money each year based upon your efforts, to us doesn't seem fair. So for our IRAs, our annual fee is $285 a year, regardless of whether it's a $70,000 account or a $7 million account. Now, the second option that you typically see in the industry is an annual fee based on the number of assets. So obviously today we're going to talk about rental properties. So if you own one rental property, that might cost you $300 a year. But if you own, say, 8 rental properties, that's $2,400 a year for an annual fee. So again, for us, we want to bring as much value as we can to the conversation. So our annual fee, again, is capped at $285 a year. So this is a huge value for those that are wanting to keep their fees as low as humanly possible. To me, the second differentiator with our service and other providers is that our operations team is tremendous. When you go online and you search different self-directed providers, you find that either they don't have a good rating with different services such as the Better Business Bureau or Google reviews, or they have a very limited rating just based on a few reviews that have come through their service. We have over 50 Google reviews, and our average review is 4.7 out of 5. So obviously, as we know online, typically reviews are coming based on a negative experience that someone has had with a business or service. So to have so many people that have been so happy with our service, I think really speaks to the phenomenal job, especially that our operations team does of taking care of our client base. So when we talk about self-directed accounts, fundamentally what we're talking about is an IRA or 401k where you as the investor get to pick the investments that make sense for your portfolio. So we're not advisors that are picking products for you. You are definitely the captain of the ship. Now, the reality is clients can use securities-based products under our platform. So people can invest in stocks, bonds, and mutual funds. But the reality is if you're only wanting to invest in that equities world, I'm the first one to tell you there are a lot better options than American IRA for that. But typically what we find is clients do want at least a portion of their portfolio in what we consider alternative assets, which we'll certainly unpack. But that's ideas such as investing in rental properties, privately held companies, precious metals such as gold and silver and things like that. So there's a lot of opportunities available to us with our retirement account. So really when we look at our client base, to me, when I see a client open an account, it's usually for one of a couple of reasons. The first is that we see clients are really wanting to truly diversify their portfolio. So obviously 2020 was an incredible year all the way around. We're still working through this pandemic, but as you look at investment assets, it has been a wild ride. The stock market had some very low lows in the spring. It's popped back up. There's been some highs. There are people that are not taking advantage of this upswing. They've been on the sidelines. Some people are just starting to get into it. It's very difficult to time the stock market. There are companies that spend billions of dollars a year on research and they still get it wrong. So for the average investor, that's tough sledding, right? What we find is clients are wanting to take some of that capital that they've worked really hard to earn, and they're wanting to really diversify so that if the stock market goes down and they're uncomfortable, they have other assets in their portfolio that are typically not correlated to what's happening in the stock market. So if you have the one rental property, for example, and the stock market goes down 30 or 40%, that's okay because you're diversified. The second component we see as a big reason why clients like these alternative assets is that they typically produce a lot better cash flow. The problem with stocks, bonds, and mutual funds is the actual investment yield that we get, the cash flow from these investments is usually really minimal. It's usually around 1 or 2% that you're making on that mutual fund, that ETF, whatever the case may be. Conversely, if you buy a well-located, well thought through acquisition of a rental property, you might be making 5, 6, 7, 8% cash on cash return with that rental property. So there's just a lot more upside for us to create real cash flow so that in our retirement years, we're not having to just simply sell these assets, but we can see that the cash flow is coming through from these income producing assets like a rental property. Now, the key is with these self-directed accounts, any type of retirement account can be self-directed. So whether you have an old 401k, an old 403b, or a thrift savings plan, if you're no longer employed with that company, you have the ability to roll that over into any financial institution you deem appropriate. And certainly a portion of that can go to a self-directed account. Also, any IRA can be self-directed as well. So whether you have a Roth, a traditional, a SEP, or a simple IRA, perhaps you have a health savings account or you've inherited a retirement account from a family member, these retirement accounts can be self-directed as well. And keep in mind, this is not an all or nothing proposition. You can decide certainly to move over the entire balance, but again, you might be looking to diversify. So maybe you're going to keep 50% or 70% of your money with your advisor or with your online provider like Schwab or Vanguard, and then move over the remaining balance to a firm like American IRA so that you can buy that rental property. So the way the IRS code is written is it actually tells us what we cannot invest in. So it's essentially collectibles and life insurance policies. So really from that, what you can extrapolate is there are so many opportunities available. So obviously we have Mitchell with us today. He's going to do a great job discussing rental properties and the real estate asset class. So we'll kind of focus on that for today. Really, any type of physical real estate can be acquired with your self-directed IRA or 401k. So it can be raw land, condos, townhomes, single-family homes, commercial buildings, industrial buildings, retail spaces, apartment complexes, you name it, these investments can be made using your IRA or 401k. There's also the ability for your retirement account to be the bank. It can actually lend money to other real estate investors so that they can take advantage of purchasing rental properties, doing fix and flips, whatever their strategy might be. And then you can make a return on your investment by the mortgage payments that are flowing back to your retirement account. Now, we'll also see scenarios where family members or friends will want to get together to purchase a single family house, for example, so they can actually get together to form a multi-member LLC, and then that LLC goes on to make the acquisition of whatever that asset may be. So there's tremendous opportunities available with these accounts. And so ultimately, again, Mitchell Puckett, Jameson Property Investment, really appreciate you joining us today. You still live on the call?
I'm here, Sean. You hear me?
Awesome. Yep, we got you. And like I said, the main event, Mitchell's going to bring it home for us today. Tremendous resource as it pertains to the Charlotte, greater Charlotte real estate market. And so he's going to discuss with us today the idea of purchasing investment properties and what that looks like.
Sure, Sean. I really appreciate you having me on. Hope everybody's doing well today. Want to just start off by kind of giving you guys an idea of who we are at Jameson. We've got three different arms, if you will: Jameson Property Investments, Jameson Realty, and Jameson Property Management. So we're call it a full service real estate group. We go out and work with investors like you to acquire single family and multifamily properties. And then we manage those assets for our investors. And then every year we go through and take a look at your portfolio and see how it's doing, seeing if we need to reallocate those investments into other areas of the city. We'll kind of get into that a little bit later. So that's generally what we do. We serve the greater Charlotte market, call it the 7 counties in and around Charlotte. So looking at real estate all over the place here, and been in it since 2006, and just absolutely love this market and love what I do. Thanks again, Sean. and we'll get right into this. So buying rental properties the right way. See if I can, here we go. So it's kind of our philosophy here. We do not like flips. We like to buy and hold typically for between 5 and 10 years. That way we can weather an economic downturn and then kind of ride it back up on the back end. And then, more tax advantageous to stay in the property for longer. So not doing super short holds. We also like rents over $1,000 per month. When you get it under $1,000 per month, you're going to have huge issues identifying good tenants, and that's what single-family real estate investing is all about: is finding and keeping really, really good tenants in your assets. So we typically like to stay between $150,000 and $300,000 purchase prices. Kind of same thing. That's kind of the sweet spot of finding the good tenants and making the best yield on your money. So we buy and hold for 5-10 years. We like to tell our investors to try to separate themselves emotionally from these properties. It's, we're always in the mindset of would I live here? And that is one of the biggest mental hurdles that we have to get over, is you are not going to be living here. It doesn't matter what the wallpaper looks like in the third bedroom. We can always change that. So we just try to, have folks separate themselves as much as they can and look at it as a business decision. So let's see. So we're trying to look for the value, and we're trying to provide the best value for you, the investor. We're in it every day. It takes time to learn, how to invest in single family real estate. There are a lot of bumps and bruises that we've been through in order to get to where we are. And we love to share that knowledge with our investors. We've also got really good partnerships here that we built over the years, from lenders to maintenance people and other resources. So another thing, it's a patient game. A lot of our folks, they'll buy a single family asset and then it won't be rented in the first 15 or 20 days. And we try to remind our investors, this is a 5 or a 10-year window we're looking at. We've got to find the right tenants, and that takes time. So we like to tell our investors, typically 45 to 60 days after you bought the investment, typically 45 to 60 days until we can find you a really, really good, solid tenant that's not going to turn over, not going to destroy the property, and it's going to, keep you cash flowing in the future. So it's just also a proven model. I mean, the model that we're working with here, it works both in good markets, and then in the down markets, our rents actually go up, especially for our 3 and 4 bedroom assets, because folks who aren't getting approved for mortgages that have larger families still need a place to live. So the rents in our market go up during recessions, which I thought was incredible when I was first getting into this. So we love single family. I love typically 3-bed, 2-bath, single story homes is what we go after. Now, you're not always going to find that, especially in a hot market like we're in right now. So you can't be as picky right now. If the numbers work, and the asset is good, we say go for it. But typically we like those 3-bed, 2-bath, single-story assets. Try to stay out of neighborhoods with HOAs for the fees, naturally, the HOA fees, and then all of the covenants and restrictions of what you can and can't do on the property. It's kind of nosy neighbor type stuff. So just try to stay out of the HOA neighborhoods when we can. And again, we're not discouraging if the numbers work and it's a good asset, then we say go for it, even if it's in an HOA. So the broken window theory, when you're buying these places, we need to make them presentable before we're showing the homes to tenants. If you show them a junky home when they first they're going to treat it like junk. And so we, want to try to deliver them, the tenants, a nice looking product. And then we know that we're going to attract good tenants that are going to keep it up. And the renters at the end of the day, they have the same dreams that the homeowners do, and they're going to take care of the asset if you present it well to them. So picking the right market, it's fun. I grew up here in Charlotte, been in real estate since 2006, and I just could not have been more lucky to find this market. It's just been absolutely incredible to watch the growth here. And just look for cities that have vibrant business climates, sound tax structures, and really good cost of living benefits. And I think Charlotte ticks all of those boxes very well, and going to continue to see really, really good growth here from all the folks moving down like I've seen my entire life from New York, Ohio, Pennsylvania, California. I don't see it slowing down. So real excited about the prospects of the future here in our city. A few things I put together for us on local statistics. Charlotte is the #1 city in America for millennial growth. And then, so it just came out that 52% of buyers now are millennials. So it's kind of, the torch has officially been passed to the millennial home buyers. So we're attracting a bunch of those folks to the city right now. 109 people a day are moving to our market. And then the silent generation is actually renting a lot more than they did in the past. So that rate is up at 32% and rising. Again, another reason why I like the single story investments when you can find them. The average rent in Charlotte is $1,410 per month. And it's funny, I did another presentation probably, call it 9 months ago, and this fact #2, average home price in Charlotte was at $294,000, and I did a double take. I had to edit this. So it went from $294,000 to $351,000 in less than a year. So we saw across our market a 16% increase in home value. In our pro formas, which we'll get into a little bit later on in the presentation, we factor in roughly 4%. So it's just blowing away our pro formas and making our investors really happy.
Wouldn't you argue though that that's still, for a large major city, that's still pretty good value in terms of cost of living?
Oh, it's incredible. Yeah, it's incredible. I mean, that's why we're seeing this. That's why we're seeing 109 people a day move to Charlotte. There's still just so much value here compared to all the other major cities that folks are fleeing from. A lot of that has to do with tax structure and how these municipalities are putting tax incentive plans together to get these large corporations down here. They've done a really good job in North and South Carolina of attracting very large businesses through their tax incentives. And yeah, it's compared to markets like Denver and Austin, and obviously the big boys like San Francisco and Seattle, it's way cheaper still, and I think that's going to continue as well. So the rents have been increasing between 3% and 5% over the last 4 years, and that's really important, obviously, for my business and what we do. We really keep an eye on that. A lot of apartments have been built between 16 and 2020, and a lot of those folks were millennials that are moving in, and they're going to be looking for larger places to rent as their families are growing. So identifying the best areas within the market. I think this is important. This is why I really love single family investing over buying a real estate investment trust, shares in a REIT, because you can be so specific of exactly where your investment dollars are going. That's what really got me into it, and it actually brought Sean and I together. I want to put my money exactly where I think that the growth is going to happen, not only within a specific city, but within a specific neighborhood, and have reasons for that. So what we look for really good school systems. We know that the homes are going to rent out well, that have, you know, the larger bedroom count homes will rent out well in the school districts. Job concentration centers, stability. We don't want to see large swings either way. We want to see a good, steady growth in value. And then finally, access and amenities. What we don't want to do is invest on tips, like something that may come down the line at some point, whether that be, you know, something that you've heard. Maybe there's a large shopping center or a power center that's rumored to be going somewhere. We're not going to just go out and buy willy-nilly because we've heard that. We want to make sure that those things like that are actually in place before we make a big decision about buying a piece of real estate. That being said, we love the silver line theory. The blue line, light rail in Charlotte, runs north and south. As you can see from the city, it goes down, follows South Boulevard, and then it goes also north up to the university area of Charlotte. And we've seen massive growth both on the commercial side as well as the residential side, spurred by that light rail line. And they have announced and spent a bunch of money planning and prepping for the east-west line, which is going to go from uptown to the airport over to Belmont, which is in Gaston County. That's one of our favorite areas right there, Belmont, and a little farther west, Gastonia. We do a lot of deals on that west side there. Folks are not only buying directly beside the rail line, they're also going out farther than where the line is proposed, because we feel like people are going to be taking advantage of living farther out and then just driving like they do on the north-south corridor, driving to the southern portion and then riding the train into town to get to work. So love that line, love the line, love that theory, and going to continue to see really good value along those corridors here in the future. So the best tools for pulling data on vacancy and rent rates, I would stay away from national data. It's so kind of, I don't want to say skewed. It goes neighborhood by neighborhood. So you want to get as granular as you possibly can with the rental data. So what would I do? I would call the expert. Go to your local realtor or your local investment specialist and ask them to pull the comps for you. I can't stress this enough. You don't want to just blindly go into it not knowing exactly what a price range within a $50 to $100 window. You don't want to buy an asset unless you know that for a fact you'll be able to rent that asset for that number. So I would get with a management company. Obviously, Jameson Realty, Jameson Property Management can supply you with all those numbers for the different neighborhoods as we're looking through the market. So can't stress that enough, to get as local as you can. Yeah, so same thing. National rates are fine, but we want to get local. And many of the big tech companies like Zillow and Trulia and those folks, they have inaccurate data, both on the rental side as well as the purchase side. So again, get with your realtor, get with your investment specialist to find out the true data. All right, and Sean had asked me to put together a little piece here on net operating income or cash flow. The net operating income, or you may hear NOI, it helps real estate investors like us determine the capitalization rate, which in turns help them calculate a property's value. And that allows them to compare different properties that they're considering buying or selling. And so NOI is a very important metric when we're looking to buy and sell, and it's a simple formula. NOI equals real estate revenue minus operating expenses equals net operating income. And so what expenses are included in the net operating income? would include property management fees. That's typically around 10% of your monthly rent will be a management fee. It's typically, it's between 8 and 12% depending on the company usually, but 10% is a good one to budget. General maintenance, so think yard work, plumbing, electrical work, any type maintenance conducted on the subject property, that can be counted in the net operating income as well under your expenses. Legal fees, and then utility bills not paid by the tenant. So if you've got a tenant leaving and you get the utility bill back into your name while you're trying to find another tenant, that can be put on your expense list as well. And then property taxes and insurance costs are all put on that expenses. How can we improve the net operating income when we're looking at an asset? It's just kind of what you'd think. It's kind of unnecessary operating expenses can undermine your profit potential if you're not careful. So it's always keeping an eye on it every month, and that's what our management company will do, keep an eye on expenses, lower the expenses. If your property's expenses seem too high or or you hadn't reviewed them in a while, just try looking at the budget to see what you can change. And then, increase your rental income. We take a look and try to be on the forefront of the rental rates and make sure that we are getting top dollar for our investors. And then just find extra income through pet fees and, maybe you've got a detached garage on the property. We've got several of those that generate several $100s a month in extra income for folks. So it's just getting creative on your specific real estate asset to where you can get some extra goodies. So what is not included in your net operating income? Your mortgage payments are not included. Again, it's as the name suggests, net operating income accounts for an asset's total income and subtracts vacancies and operating expenses. And so other expenses, mortgage interest, income taxes, debt service on the property, the depreciation that you're going to be taking, tenant improvements, and then a repair for wear and tear. Those are all not included in your net operating income. So calculations that are going to be using the net operating income or the capitalization rate or the cap rate of a property. It's the calculation used to show a property's potential rate of return. The formula uses net operating income divided by current market value and then multiplied that by 100. Debt service coverage ratio, and then the return on investment is calculated by taking the net operating income and dividing it by the purchase price of a property and then multiplying that by 100 to get a percentage. The ROI is another calculation used to help investors gauge a property's potential. And then cash on cash return. And that is the investment formula that looks at NOI or net operating income in relation to the initial cash investment made on the property. And this can help investors estimate the annual cash returns of their deal. And so Sean asked me to put together kind of a quick, this is our pro forma that we use with all of our investors. First, what we like to do, and you guys can do this as well, when you're first taking a look at an investment, just look at the gross yield. And what we do there is we say, okay, we think we're going to be able to get, call it $1,500 a month in rent. You multiply that by 12 to get the yearly gross income, and you simply divide that by the purchase price. So that's our gross yield. And if the gross yield is between 8 and 10% or higher, then we do the work to get into the due diligence and start plugging in all the numbers into this spreadsheet that we've got that'll show you the true returns. So that's kind of the back of the napkin way that I look at all of my real estate deals, is by gross yield. And again, it's the yearly rent divided by the purchase price. And so I prepared this here. So let's say a property hits the market for $215,000. We think it's probably worth between $210,000 and $215,000. We buy it for $205,000. We're putting 100% down in this scenario, so buying it for cash. We think the cost of repairs is going to be about roughly $10,000, so that brings us up to a $215,000 all-in number. That'll get us, say we need new LVP flooring and perhaps some paint in the bedrooms, in the bathrooms. That'll get us $10,000, so we're at $215,000. Then we think that we're going to have $1,500 per month in rental income, and we'll plug in a vacancy rate of 5%. So that'll be $1,425 in net rental income every month. And then we'll go look at our expenses. So $105 property management fee, $66 leasing fee, $100 per month maintenance reserve. We like to have what I call a slush fund set aside with about 6 months of expenses, just in case something goes wrong. If a tenant has to be evicted, or if a HVAC unit breaks or something like that, we're going to want to have a fund in place in order to make repairs, or if you've got debt on the property, pay your debt service, taxes, and insurance while we're getting a new tenant in place. But that maintenance reserve fee, we like to put in roughly $100 a month on a deal this size, and that'll just grow over time until you need to use it to fix what's broken. And then you're going to have your property taxes and insurance there as well. So our total expenses are going to be $453.67 every month. So what do? We're going to $0.67 for 25, and that gets us $971.33 a month. And so that's kind of how we get to the net operating income without having under the investment analysis, appreciation is going to be about 3% per year. So we're right there in that strike range that I showed you earlier on the slide. And then our appreciation of the actual real estate, we have 4.3%. That's more of a national average. We want to be very conservative when we're doing these pro formas for you guys. And again, that number across the board in Charlotte was 16% appreciation rate last year. And so the rental income is great, but we're making the real money when we're selling these assets. So really, really good to see those appreciations going up the way that they are. So that's my presentation on net operating income and kind of what we like to do in investing in real estate and single family and multifamily here in Charlotte. And I would love to answer any questions that you guys may have if you want to type it into the chat box. And then Sean, if you'd like to take the screen back, sir.
Awesome. No, that was great stuff. I appreciate that. So yeah, I'll just pop up this screen. As Mitchell said, anyone listening live, if you have any questions, please feel free to type that in, and we can definitely dig into that for you guys. So really appreciate that. As you guys can see, this is why I've learned a lot from Mitchell over the years. The guy knows his stuff. So we'll go ahead and see if we have any questions opening up here. Yep, we got a number of them already. Perfect. Are all expenses such as repairs tax exempt? You have to declare at tax time. So I apologize. That might actually be assuming that we're buying these properties inside of a retirement account. So Mitchell, if you don't mind, I'll take the lead on that one. So there's kind of two scenarios when you're dealing with rental properties that are owned by a retirement account. If it is a cash acquisition in the example that Mitchell put together for us, that's a scenario where you're in a tax deferred vehicle or a tax sheltered vehicle. And so in that scenario, you're not going to have to worry about deductions or write-offs, as we all get to enjoy when we do our rental properties outside of retirement accounts. There's a lot of tax benefits Now, if you are using leverage inside of a retirement account, so your IRA or 401k is actually borrowing money from a private lender or from a banking institution, we are going to work with our CPAs to help us with the calculation. Long story short, if there's leverage on a deal, depending upon the structure of the deal and the type of retirement account, we might actually need to utilize the deductions that we're all kind of used to as landlords. So that's a great question. And thank you for that. So yes, levered deals, we're going to be cognizant of deductions. Non-levered real estate deals, we're not going to have to worry about deductions based upon the tax sheltered nature of retirement accounts. Okay, so the next one is definitely for you, Mitchell. Are you saying you don't advise holding properties longer than 10 years?
Not at all. Yeah, great question. That's just what we've seen in Charlotte and what I've been doing. We like that 5 to 10 year mark. So say I'll just give you a scenario. Say I bought a $100,000 house in downtown Matthews 10 years ago, and it's now worth $250,000. Is my money better served staying in that specific asset, or is it better served selling that and then buying 2 other homes in Gastonia? So it's just on a asset by asset basis of whether we like to hold it longer than 10 years, or if we like to reallocate those gains that you've made in a really good investment. Hopefully that answered your question.
Yeah, and now, Mitchell, do you guys sit down with clients to kind of reverse engineer what their goals are to see if being a little bit more transactional is going to help them kind of build that portfolio, or how do you guys think about those situations?
We do. We like to get with each client every year on the year, and then go through exactly what they have, what their goals are, if their goals have changed, because a lot of times, stuff in life changes and your financial goals change. So yeah, I like to be in front of my investors as much as possible. Love answering any questions as they pop up, no matter how large or small. But yeah, we like to take a look every year to make sure that your money is in a really good asset.
Okay, great. So the next one is, how do you estimate general maintenance costs since they're so variable?
Yeah, so age of the home. One of the kind of value adds that we bring with Jameson Realty is, so you engage us as your broker, and we go out, and it's just like you're buying a single family house of your own or a townhouse house of your own. We are going to go in and we're going to negotiate for repairs while it's under contract. So we put the real estate asset under contract, and then we take it through the inspection period, and we try to catch as much as we can and know what we have, and kind of put a life on each, the mechanicals and roof and the foundation. We like to go through with a fine-tooth comb and make sure we know exactly what we're buying. And then we can kind of say, this is how much we need to be putting in reserve every month. So, but it's completely different. So, I've just put an investor on a house that is a brand new build. So it's going to be very minimal what we need to be putting in reserves on that piece of property, as opposed to the one that I'm closing tomorrow in downtown Belmont that was built in 1906. So yeah, it just it depends. It depends on the age of the real estate asset for how much you need to put aside.
Yeah, no, that's good stuff. I appreciate that. Okay, so we have a tremendous amount of questions, so I apologize. I'm going to kind of group some of these together that are kind of similar in topic. But yeah, a lot of great questions. So I appreciate everyone taking time to type these in. So we'll kind of combo this question for both businesses. The question is, what is the minimum investment you require from investors? So on the self-directed IRA end, really our requirements are that you're keeping at least $750 in cash at all times inside of the retirement account. Certainly, depending upon your strategy That will vary greatly, obviously, as we're talking about rental properties. If you're looking for a cash acquisition of those assets, then you'll need to have a pretty fair amount of capital to work with. Mitchell, for you and your investors, do you have kind of a starting point in terms of available down payment cash, or how do you guys look at potential investors?
Great question. Banks want to see 25% down on an investment property. I will tell you this, I just refinanced all of my investment properties because of the how cheap money is now. I'm just got the last one done at under 3%, 30-year fixed. So we've got some really, really good mortgage folks here that are doing incredible deals for us on the investment side. So say, you know, we like to say $150,000 is where we like to start. So if you do 25% down on a $150,000 house, that's $37,500. And then I would say at least another $10,000 to $12,000 just to in that fund to, you know, to continue to be able to make payments if something goes wrong. So I would say just shy of $50,000 in cash, and we could get, you know, a $150,000 asset that'll be generating a good amount of income for you.
Okay, perfect. So some of these questions may or may not be in the realm of what Mitchell can discuss, but we'll go ahead and shoot it to you. And Mitchell, you feel free to punt, or, you know, let us know if you want to bring in additional resources. There's a question regarding the tax rates on income for North Carolina. Do you happen to have any figures on that?
I would say speak to your CPA on anything tax related. I don't want to give misinformation because those tax codes change a lot. So I just pick up the phone and call my accountant, or just try to go on the IRS tax code website and try to look at it that way.
Yep, absolutely. Yeah, and we do the same thing a lot on the self-directed IRA end. There's a certain level of guidance we can give you in terms of the account being compliant, but many times clients are going to need to bring in their tax and legal resources. The next question is, how many mortgages are you able to get nowadays? So on conventional products, that's going to be 10 mortgages in your personal name, but talk to your mortgage broker, because there will be situations where you could have non-recourse loans or loans that you haven't personally guaranteed that won't count against that 10. But as a general note, 10 is kind of a good starting point. Now, keep in mind, obviously, that's the retirement account end is kind of a different model altogether. Those are very different types of loan products, as they have to be non-recourse. So if you're looking to leverage inside of a retirement account for rental properties, there's kind of a whole discussion around that. But yeah. Okay, so how do you find your single family properties for your investors, Mitchell?
Combination of things. We do a lot of stuff directly off of the MLS, and look at it every day, and I go into homes every day, and my brokers as well go into homes every day. Some of them are word of mouth. You know, like I said, been here since or been in real estate since 2006, but been in Charlotte my entire life. So I know a lot of folks. I know when they want to sell. We also have a lot of investors. We manage about 400 homes around Charlotte. A lot of investors who are, you know, looking to sell. They don't mind us sharing it with our newer investors first. So, you know, kind of, I think 18 to 20% of our investors or of our investment homes that we manage sell every year, and then kind of roll into new products. So a lot of those are being sold off, and we put newer investors on some of those. And then we kind of stay away from foreclosures. Just hadn't really gotten into that world, but I would say it's more word of mouth and through the MLS. And then we work with several folks that will go bird dog for us. They'll go out and try to find a piece of property, they'll put it under contract, and then they'll sell it an assignable contract to us or to our investors. So there are several ways that we're sourcing these deals.
Okay, great. The next one is do you consider investing in multifamily units around Charlotte?
Yeah, I do. But they're expensive right now. And all the really, really good ones have been gobbled up over the past decade or so. So they're very tough to come by. You know, it helps with vacancies. If you've got debt on the property, you're getting some income every month, even if you've got some vacancies. But you know, they're a little tougher to manage. A lot of them are lower in rent, and then they're priced higher right now on a cap rate basis than the single family is. So that's why I like to stay on the single family side. But we can help we help folks buy duplexes and quadplexes. So yeah.
Okay, great. So a number of questions about out of town investors, out of state investors. So one of the questions specifically was, do you have to be local to the Charlotte market to purchase in Charlotte, or do you work with out of town investors as well?
Great question. We work with a lot of out of town investors, and that number is going up since COVID. So a lot of people in our industry started doing virtual tours just with their cell phones to take a look, even if they're just buying a house, you know, not for an investment, but to live in. So a lot of our investors are now just doing a Zoom call, and we'll take the phone through the house and show them the asset, and then they'll make up their mind. And then a lot of them that have been working with us for years, you know, we call them and say, hey, this house is on the market. We think it's a good buy. And because, you know, we've done so many deals with them in the past and we've showed them good returns, they'll just say, okay, buy it. So some folks want to be at every meeting and really go through the entire process, which I appreciate. And then others, you know, we've got some folks in Japan. So it's all over the map.
Wow. So there's been a lot of questions about the fees for your service, presumably on the brokerage and the property management. Can you just kind of talk a little bit to how you structure the fees there?
Absolutely. So like I said earlier, we're your real estate agent. We're your broker. 99 times out of 100, we're going to be getting our fee from the seller. And maybe, you know, on a one-off where I find something off market and it still hits all the numbers, then it'll just be a 3% buyer agency fee. But for the most part, you know, like I said, 99 times out of 100, it's paid for by the seller. So that's on the buy side. On the management side, once we're managing your property, it's a 10% per month fee, and then it's half first month's rent. So upfront, so when we get the tenant, it's half the first month's rent, and then it's a 10% fee in perpetuity. And then if you have multiple properties with us, that number goes from 10% to 8% for the other for the properties. So if you have 2 or more properties with us, that number goes from 10% per month to 8% per month.
Okay. Solid. Perfect. Can you put a current property that you own into a self-directed IRA? Unfortunately not for the retirement account. It cannot be a property that's ever been owned by you, a spouse, or your lineal family members, essentially the group of people that we call disqualified persons, as well as any sort of entities that they own or control. So if you ever owned a property in an LLC, the same would be true in that scenario. All right, let's see.
Can you quickly go through what a disqualified person is?
Yeah, absolutely. So let's say that that Mitchell's looking to use his IRA to purchase an investment property. He wouldn't be able to purchase a property that he's personally ever owned, his spouse has ever owned, any LLCs that they own or control, and then their lineal family members as well. So like any parents that have ever owned the property, grandparents, great-grandparents, etc., the downline is the children, grandchildren, great-grandchildren, and their spouses. So really, the best way to think about it is to identify if anyone in your family has ever owned it, and then essentially we can kind of disqualify some people as irrelevant to the conversation. So oddly enough, let's say Mitchell's sister at some point in time owned a property. His sister, under most circumstances, would be able to sell the property to his retirement account because she is not a disqualified person. But if Mitchell's parents ever owned the property, they would not be able to sell that property to Mitchell's IRA. So kind of an interesting, weird IRS rule there, but some family members are okay to have done business with under normal circumstances. Okay, the next one is Mitchell. How about a couple more? You up for a couple more?
Let's go, Sean.
All right, I love it. This guy's always got energy. This is good. All right, so as a general guide, do you recommend your investors pay with cash or buy with cash, and buy less properties, or use leverage and buy more properties?
It truly is investor specific. So folks that are just starting out, I say you use this 3% money right now and then have the tenant pay it down. But folks that are looking for higher income every month, just buy less and have less expenses. So if you're looking to maximize the amount of assets that you have and kind of break even on a monthly basis, which a lot of folks do that, then buy as many as you can. And then if you're looking to generate monthly income, buy less of them and have a higher monthly income. But we speak, we try to sit down and put a really good plan together with a new investor, and then kind of flesh that out. Yeah, absolutely. Always the big debate, right? Use leverage, not use leverage. It's just a comfort level thing, a goal centric type of discussion. So we'll do a little bit of a fire round. So just in an effort to get through as many questions as we can, Mitchell, just feel free to kind of give us, it could be yes or no. It could be just very, very straightforward. We'll just try and get through as many as we can. How old or new are your investment properties? 2021 back to 1870. If it's a good property and it's really old and we know and we've gotten our inspectors in there and know that it's a good property, I don't mind going as old as we need to. And then, if the HOA fees aren't killing you, we'll go into a new neighborhood. So it's just, it really is all over the map there as well. Yeah. Greensboro, North Carolina. Are you guys in that market? We are specifically just here in the Charlotte MSA, so we are not in Greensboro. But okay, I know some folks to chat with. So offline, if you want to shoot me an email, I can connect you. Perfect. A lot of these now are kind of IRA specific, so I'll just kind of fire around one or two. Using my self-directed IRA, I assume it's my responsibility to find properties and to do the negotiating. So certainly, American IRA will not be finding products for you. However, if you're working with resources such as Mitchell, such as Jameson, such as, kind of real estate professionals, then they can certainly add a lot of value to the process of negotiating out deals. But certainly if you're working individually on a off-market deal without any realtors involved, then yes, American IRA will not be negotiating on behalf of you. We will just simply sign documents that you instruct us to for the purchase or sale. So thank you for that. If we choose to do some financing, should we approach a bank first before we begin looking for a property? Yes. So if you're going to use leverage inside of a retirement account, you definitely want to have discussions with non-recourse lenders. They're few and far between, and their structures are very different than the sweet loans that Mitchell was just talking about that he refied into.
the terms are not going to be as desirable. So you want to kind of back into the numbers just to make sure that they still work on levered deals. So good question there. Again, really, Mitchell, I appreciate the time. Really a lot of value there for us today. Any other thoughts or comments as we sign off here?
I just appreciate you as well, and looking forward to doing more deals with American IRA. I don't know if the folks on the call know, but I don't think I mentioned it, but I have my American IRA account set up. It did not take long. We've already done deals through my IRA account, and could not be happier with Sean's service. So I can't recommend him and his company enough. They've been phenomenal to work with. And then if anybody has any questions or comments for me, just give me a holler. I think my email's on there, my phone. Call me anytime or shoot me an email. Love to get with you and chat more about real estate here in Charlotte.
Awesome. Good stuff. Well, again, I appreciate everyone staying on the call here. A lot of really great questions. I know it's in the middle of a work day for many people. So thanks for carving out some time for us. Again, Mitchell, a lot of great value here today. So thanks for taking all the time to do the prep work, to add some real value and some really interesting stuff. So again, as Mitchell said, feel free to reach out to the appropriate parties for your questions and any scenarios you want to go through. And we'll be happy to assist you moving forward. And thanks so much, everyone, and have a great day.
Thank you.
Thanks.